everyone. Thanks for joining us today. Welcome to our Low-Income Housing Tax Credit webinar, where we are focusing on the 7 resident file compliance pitfalls to avoid. And with that, we are going to get started here. And I will introduce myself. My name is Pam Roberts, and I am a training account manager with Grace Hill, and I've been in the industry for almost 30 years now. And my background is compliance and training. And with me today, I am thrilled to have Karen Graham. And Karen, I'm going to go ahead and let you introduce yourself.
Hi, Pam. Thank you for having me. My name is Karen Graham, and I am the president and CEO of Karen A. Graham Consulting, based out of Cincinnati. I've been working in the tax credit arena for about 25 years, and I started off on site as a leasing agent, worked my way up to a property manager, a multi-site manager, and a director of compliance. I've been consulting for about 12 years now, and I am happy to be here.
Oh, great. And as I said, we are very lucky to have her today, as she's the author of our LIHTC series, so thank you, Karen. And we're going to go ahead and get started with Karen giving us a brief description of the LIHTC program. So go ahead, Karen, and let us know a little bit of information about that.
Sure. The Low-Income Housing Tax Credit Program was enacted by Congress as part of the Tax Reform Act of 1986. So the program's been around since the late 80s, early 90s. You may actually know this under a different name because it does have a couple of different names. So LIHTC is the Low-Income Housing Tax Credit Program. LIHC is the Low-Income Housing Credit. TC, or Tax Credit. HC, or Housing Credit. And then a term that we like to use with the general public is affordable housing. One thing to know about the tax credit program is that it is not a federal subsidy. This program is not operated by or monitored by HUD. Instead, we operate under Section 42 of the Internal Revenue Code, and so we operate under the IRS. And as you can tell from the name, tax credits are involved. So what is a tax credit? It's a dollar-for-dollar credit against a tax liability. And so your owner has built or rehabbed your tax credit property and promises to make those available to low-income households and families. In exchange, they are offered tax credits, or that dollar-for-dollar credit against the tax liability.
Okay, well, that sounds like it's very important for the owner to continue to claim the tax credits every year. So, Karen, can you expand on the importance of the compliance?
Sure. So once the owner applies with your state agency, or maybe it's called your HFA, your Housing Finance Agency, they apply for those tax credits. They say to the state, this is the project that we would like to build. It is a competitive process, but once those tax credits are allocated to the owners, so the state agency approves that project, those tax credits are allocated. Once those tax credits are allocated, then the new construction or the substantial rehabilitation begins. And that is when management steps in, and management is charged with the responsibility of ensuring that the residents that are living at the project are qualified. And this is going to be for a minimum of 15 years. For a lot of us, it could be 30 years. And so there are some long-term requirements that come along with this, and that's called tax credit compliance. making sure that the residents are qualified to live there so that the owner can continue to claim those credits year after year.
That's right. So Karen has authored our wonderful LIHTC series that is available on Grace Hill. And what we're here today is to offer you the top 7 resident file compliance pitfalls to avoid. So Karen, how did you determine those 7 items before we get started?
Well, in working in this industry for so many years, starting on site, I've been there. I know what it's like for sure. As a director of compliance, I was responsible for making sure that staff members on site had what they needed. And then in the role that I'm playing now, we do a lot of file pre-approvals. So we see files before the applicants move in. And I do work with investors and owners on doing desk audits and on-site reviews. And so over the years, I've looked at tens of thousands of files and have done thousands of audits. And so with that experience, I've put together this list of the top 7 items that we note the most as far as resident files go. So in the resident files, as you're processing those applications and moving those households in, the resulting file, these are the top 7 items that we tend to note when we're doing our audits.
Well, I'm excited to see what you've put together. So let's review the very first one and take a look and dive right in. And number 1, Karen lets us know about staff not trained.
Yes. So sometimes we do experience some turnover with our on-site staffs, leasing and assistant managers and managers. That's the team that is really responsible for accepting those applications, processing those applications, and conducting the move-ins. So obviously it's extremely important that those staff members, number 1, understand the program regulations. How is it different from other programs? What the regulations are. You need to know from the IRS, and you need to know from your state agency. And you also need to know, your company policies, for example. So what are the regulations? And number 2, what are the risks? For an average size property, the value of the low-income housing tax credit is going to be in millions of dollars. By not complying or by having non-compliance at your project, that's what's really the risk, those millions of dollars in tax credits. We have a very important job then to do because we have to ensure that these resident files are in tip-top shape so that we are easily able to demonstrate that the residents are qualified to live there. Does your staff know what they say they know? We can say, yes, we know the low-income housing tax credit program, but do you really know? And do you have ways of assessing what your staff members know and what they don't know? Those are all very important, making sure that your staff is trained.
Yes, I couldn't agree more. And in addition to this presentation, everyone, Karen put together a PDF resource that will point you to the exact location in the LIHTC course series that covers each of these resident file compliance pitfalls to avoid. So you've got me excited with number 1, Karen. Let's take a look at number 2, is not prepared for an audit.
Yes. So when I do on-site visits especially, I find that those that are most prepared tend to have the best results. And so if you're winging it, you're maybe not fully prepared for those auditors to be at your property, you're probably not going to have the best results. And so not being prepared obviously is a huge reason for noncompliance. When you are fully prepared, audits are going to go more smoothly. So you want to be sure that the auditor is impressed. They're impressed with your property, they're impressed with your files, and they're impressed with you. When you are fully prepared, hopefully that auditor won't take a very critical or detailed approach to that audit. If they can sense that you are trying to wing it, it could result in that auditor taking a more critical, detailed approach to that file audit. So you want to be sure that you're prepared for those audits.
I agree, Karen, so much. I come from that compliance background, and I often recommended to my associates to make sure everything looked perfect so we could reduce the need for that auditor to dig into those files. So I'm excited to hear the information that you just shared, and more excited to hear about number 3, which is documents not signed.
Sounds pretty simple, doesn't it? Documents not being signed. Piece of cake, right? Well, it's one of the top items that we tend to note. And the good thing about this is it's one of the easiest to recognize and easiest to self-correct. So, for example, verifications must be signed and dated by the verifier. So let's say that an applicant is employed, and so you send off the verification of employment to the employer. The employer completes that verification. They tell you about their hours and their overtime and bonuses and changes, year-to-date, etc. You want to be sure that when they send that form back that they've properly signed and dated it at the bottom. The TIC, or the Tenant Income Certification, is the certifying document that's signed at the point of move-in. The residents must sign that, and the staff must sign that. That's where they say that, yes, this is my household composition, this is my income, my assets, and my student status. You want to be sure that's properly signed and dated. The rental application, or the recertification application, also needs to be completed and signed. Every file should also have an income questionnaire where the applicant or the resident tells us, usually by a yes or no answer, to all the potential income sources. They do the same for assets with those yes and no questions. They're telling us maybe about their student status on there too. You want to be sure that's properly completed and then signed and dated. Sometimes the files are going to have affidavits and certifications, and that's where an applicant is telling us something specific. So, for example, maybe there's an affidavit of child support in the file, or for certifications, maybe it's a student certification where they tell us about their student status. All of those need to be signed and dated properly by the applicant. Again, it sounds simple, but it is something that we do find is a common finding.
Yes, definitely, Karen. I think when I used to do those audit findings, same thing. They revealed missing signatures, and again, easy to correct, but we have to make sure that we do review that information. She is right on target. So let's take a look at number 4, failing to verify everything.
Yes. So the rental application and the income questionnaire is the foundation for every file. This is where the applicant has the opportunity to tell us all the different things that we're asking. So household composition, income, assets, and student status. So depending on your forms packages, you want to be sure that all of those are being completed correctly. Those might be state-specific forms or company-specific forms. Some ways to avoid noncompliance on failing to verify everything is this. On the rental application in the income questionnaire, you want to be sure, number one, you're asking the right questions and you're asking it in the right way. We need to be sure that all the low-income housing tax credit specific questions are being asked and answered properly. You want to be sure those forms are specific to the tax credit program and not other programs. And also you want to be sure those forms are not related to the market rate or conventional application. So on that application, you want to be sure that those yes and no questions are answered. And for most of us, when the resident or applicant indicates a yes answer, that's going to be tied to a specific form. So where it says, for example, are you employed? And the applicant says, yes, I'm employed. You're going to have a form tied to that, for example, a verification of employment. So every time you see a yes on that rental application or income questionnaire, you want to be sure that it's being addressed in the file.
Agreed. So this is why it is so important for employees to understand these regulations, which are all covered in detail in Karen's LIHTC series that's now available on Grace Hill. Number 5, I have to say, Karen, is not one of my favorites, but let's go ahead and take a look, and everyone will see why when we see what number 5 is, and that is asset calculations.
Not one of my favorites either. These assets can sometimes be quite complex, and when our applicants and residents fill out their income questionnaires with those yes-no answers, we want them to be as specific as possible so we know how it is that we are to verify these things. The hard part about assets is that sometimes it's an asset, but then other times it's actually income, and then other times it's neither. And so it's really important, number 1, to know what's considered an asset, number 2, what's considered an income, and number 3, when it's really neither. Sometimes when we get those verifications back, we have to put on our CPA hats and say, okay, here are some stocks. What do I do with this? Or here are this is an annuity. How do I handle this one? And so it can be pretty complex. For some of us working on family projects, for example, we may not see assets all that often, and so we have to remind ourselves about these program requirements. For some others, maybe you're on a senior property, for example. You might be at a property where a lot of your residents have a lot of assets, and so you need to know how to properly ask those questions on the application, and then once they're verified, you get the information back. What do you need to do with it? Is it income or is it an asset? All very important, and these number 5 asset calculations are one of the top 7 items that we do note.
Right, so you heard Karen talking about details with these calculations. So in that PDF resource guide, she has included the courses in the LIHTC series that specifically cover how to make these asset calculations. So thank you for that, Karen, because we're all going to need that extra information. And then speaking of calculations, it continues, everyone, with number 6, program calculations. So what can you share on that information, Karen?
Assets can be quite complex, but then income can also be quite complex. And one thing to remember is that the low-income housing tax credit calculation requirements are different than other affordable programs. So if you happen to be coming from, say, a HUD background, for example, You really need to listen up because the low-income housing tax credit program does calculate income differently. And if income is undercalculated, it could put a household over the maximum allowable income. And when a household is over the maximum allowable income at move-in, for example, that is considered an unqualified or ineligible household. And so that's what we really need to work to avoid. Now, we do take a look at their current circumstances for income, but then it's important to also realize that changes and differences also need to be addressed and added into the income. For example, unemployment. The employer verifies that they're going to be getting a raise in 6 months. That needs to be added into the income now. Also, there might be an income source that's not being received right here and right now. However, because we do have to anticipate and predict income for the next 12 months, even when they're not getting it now, you still might need to verify and count it. So how can we avoid these program calculation errors? Number one, you have to know what's required for the tax credit program. Training and education obviously is key. And then a second point that I want to talk about here is showing your calculations. Some of us are lucky enough to have property management software packages where you can enter the income information and then it's populated into an income worksheet. If you do have those, take advantage of those and use them. If you don't have those, then I would strongly encourage you to use a cell-protected calculation worksheet, maybe in Excel, for example, where you have the opportunity to enter all of that data. Say you're working with pay stubs, for example. You need to enter in all those pay stub amounts and average those out and then maybe do a year-to-date annualization. You want to let that worksheet do the work for you. You want to, again, be sure that that's cell protected so you can't mess up any of those formulas. If you're not lucky enough to have that, then at a minimum, you want to be sure that you're using adding machine tapes. Your auditor has to be able to follow along and see how it is that you came up with their total income. You want to be sure that you are not handwriting any calculations ever. That is forcing your auditor to recheck all of that handwritten stuff there, and you don't want to have them trying to see, is that an 8 or is that a 6? And so avoid those handwritten calculations at all costs. And then another recommendation is to be sure that every file is sent off for approval. You really want to have a second set of eyes taking a look at your calculations. We are pulled in 20 different directions when we are out on site, and it's really, really easy to make a mistake in doing these calculations. One little mistake can cause a household to be over the maximum allowable and unqualified for the program. So you really want to be sure you have a second set of eyes taking a look at all those files for you.
Right. I know there's a lot of people like me. We never see our own mistakes. So no matter how long we've been working with calculations, verifications, files, it's always a good idea to have somebody double-check your work. It could be anyone in your office because everyone can see something that you can't see. So great information, Karen, and we are already to the last item. It's gone by very quickly. So here it is, number 7, full-time student households. So let us know about this wonderfully confusing item here, Karen.
Yes, The full-time student rule for the tax credit program can be a source of heartburn for some of us because it's not the easiest to understand. It's not the easiest to explain to our applicants and our residents, but it does tend to be one of the riskiest items because there might not be a full understanding of what the program regulations call for. So the rule says that households cannot be comprised entirely by full-time students. So it doesn't say full-time students are prohibited. It says households comprised entirely by full-time students are not eligible. But there are 5 exceptions to this rule. So even when the household is comprised entirely by full-time students, they do have 5 chances to meet one of those 5 exceptions. And so, number one, it's really important that you understand that this rule is quite different than any other program. So it's completely different than HUD. It's completely different than the home program. You need to know specifically for the tax credit program this full-time student rule. If a household is comprised entirely by full-time students, and you're trying to meet one of those 5 exceptions, that exception must be verified and documented in the resident file. So you want to be sure that your rental application or your recert application is asking the right questions. So you want to be sure it's specific to the tax credit program. And then another biggie is being sure that each adult is completing a low-income housing tax credit student certification. It's going to ask each adult what their student status is, and they have choices that they can check the box on that form. Again, if you need to meet one of those 5 exceptions, be sure that that's in the file. And then one tip that I have where I tend to see some of these full-time student errors is the applicant might say, no, I'm not a full-time student, but then the application tells us otherwise. So one tip to look for example, is when I'm looking at the application, it says what their current residence is and their reason for moving. If I see things like, I'm moving to be closer to school, or I'm moving because I've just graduated, that should be a red flag to say, okay, is it possible that they are in fact a full-time student, and that needs to be verified in the file.
Good information, and we've hit on this a couple of times. This is the one that is really most confusing, especially to those who have worked with other affordable programs. So Karen does cover this subject in detail in the LIHTC series. And speaking of the series, we are wrapping it up. We've went through those top 7. So thank you so much, Karen. And just to let you know that we do have the resource guide that is available with this recording. And this is so nice because, again, Karen addressed everything in this webinar, those top 7 resources that we have covered in compliance pitfalls. So all of that information is in that resource guide and obviously covered in our LIHTC course series. So with that, we are going to go ahead and thank Karen so much being here today, you being the author of our LIHTC series. Well, there's no one better that we could have to introduce this program. I think you have offered a lot of information to everyone here today.
Thank you, Pam, for having me. I'm really excited to be working with Grace Hill. I sure hope that this webinar is informative, and I'm really looking forward to the LIHTC compliance series being offered in Grace Hill, and I sure hope that it's a really great resource for everyone.
Right. So here I am, Pam Roberts, and just want to invite you to visit graceville.com to learn more about our LIHTC series. We are thrilled that you were here today. Thanks for being with us, and we hope to see you on the website soon. Thank you, everybody.